Hi guys, good morning and welcome to Money Control. You're watching Opening Bell with me, Nandita Khemka. Very important day, given the fact that yesterday, late night, we heard the finance minister, the GST Council meeting that was supposed to be a two-day affair, ended on the very first day with unanimous consensus on all the proposals when it comes to GST rate structure. Of course, we are ushering in the new GST regime, GST 2.0 as we call it, with a two-tier rate structure, 5% and 18%. So yes, that's a reality. We have seen a fair bit of, rally in some of the sectors after the, announcement by PM Modi on the 15th of August. But there are certain sectors that haven't really fired up for the likes of cement, for that matter. We'll ask our experts. We'll get your battery of expert views on, which are the themes that one should be looking at to ride this GST overhaul. Of course, autos, aside of autos, even FMCG stands to benefit. Household savings also is expected to improve substantially. And of course, India will be getting a consumption boost as a result of the reforms announced by the GST Council yesterday. But yes, lots to watch out for in the pre-open. We saw the Nifty hitting that 25,000 mark. And looks like the bulls really got a whiff of this yesterday itself. Because in the second half, we saw the Nifty stage a very smart comeback from the day's low. In fact, to clear that 100-day moving average level and shut shop above that. So today, whether we will, clock the 25,000 mark and shut shop above that, that will be very, very critical to watch out for. So yes, lots lined up over the next 1 hour on our show. So stay tuned. And of course, send in your queries, especially if you have any queries, related to some of these sectors that will benefit from GST reforms. Keep them coming in. We will get them addressed by our viewers. So yes, 25,000 looks like we are poised to start around that level. Let's see how really things pan out. But before moving any further, quickly take a look at the top headlines, and then we'll get our experts on board as well. India's new GST regime is here. The GST Council approves the two-slab structure of 5% and 18% and a special 40% rate for sin and super luxury items. The new rates will take effect from the 22nd of September. Prime Minister Narendra Modi hails the move, says the common man will benefit greatly. Small cars will now face 18% GST versus 28% earlier, while motorcycles under 350cc and three-wheelers get cheaper and have been brought under the 18% bracket. Electric vehicles remain at 5%. In a big boost for consumers, GST on insurance has also been exempted. The GST Council has exempted individual life and health insurance from GST. In addition, GST on reinsurance cost is also exempted. A big boost for the consumption story as new GST rates save big on daily essentials in the 12 to 18% bracket to now 5%. Electronics such as ACs, TVs also see a cut from 28% to just 18%. Just to look at the global texture, then tech rally boosted Wall Street overnight as key indices closed with gains. Dow, meanwhile, ended with marginal cuts. Asian markets were trading with good gains this morning. The GIFT Nifty, of course, in fine petal was hinting at a gap up start, and in the pre-open, we've already seen the Nifty clear that 25,000 mark. Well, then, just quickly taking you through the changes that have taken place as a result of these reforms. Of course, two-tier structure, 5% and 18%. That's a reality now. September 22nd is when these new rates kick in. Special rate of 40% without cess for thin goods. That has also been announced. Now, our items in the 5% slab include the likes of hair oil, toilet soap bar, toothbrush, cycles, tableware, household articles, etc. If you look at some of the items that have been exempt from GST, they've come to nil from 5%, are paneer and all Indian breads. Namkeen, sauces, pasta, instant noodles, coffee, butter, ghee, cornflakes, chocolates. So all of these stocks like Nestle will be in focus, and they will benefit even the likes of Britannia. So watch out for those. In terms of white goods, ACs, all TVs, dishwashers, small cars and motorcycles, under 350cc. We'll be talking about autos in greater details, but 28% to 18%, that's the change there. For cement, GST rate has been cut from 28% to 18%. For medicines as well, the GST rates have come down to nil actually. For GST on 33 life-saving drugs and medicines have been cut from 12% to nil. And some life-saving drugs, cancer drugs, those medicines have also seen a cut in GST rates to 0%. Autos, as I mentioned, small cars now fall under 18% bracket. For three-wheelers as well, it's the same. Motorcycles above 350 cc, however, will be in the 40% tax slab. And auto parts, which earlier had different rates, will also be taxed at a uniform rate of 18%. So that's also some bit of clarity that Motown has got and was much really awaited. But in terms of insurance now, individual life insurance premium is exempt from GST. Health insurance premium, individual floater policies for aged people are all exempt from GST. So for consumers, it's a shot in the arm. But for life insurance firms, we'll have to see how they react in trade today, given the fact that there will be no input tax credit and there is no clarity on what kind of relief they'll be provided by the government. So that could weigh in on some of the stocks today. We'll have to see at 9:15 how they really pan out. But in terms of the items in 40% slab, aerated water, carbonated beverages, caffeinated beverages, non-alcoholic beverages, all these fall under the 40% slab. Motorcycles above 350 cc and helicopter, yachts for personal use, for pleasure. These are some of the items that will fall in the 40% category. Also, of course, bigger cars, they will also fall under this category as well. Items like pan masala, cigarettes, gutka, tobacco products will not move to the 40% slab as of now. That will be continued to be taxed at the old rate of 28% until all pending loans and compensation payments are cleared. So all in all, these are some of the reforms that were announced yesterday. Most on expected lines, but of course, big boost coming in for mass consumption, smaller cars, etc. And that, of course, was already being anticipated. And we at Money Control have also been reporting about the proposals as well. But on that note, before the market open, let me get on board Chandan Taparia of Motilal Oswal. Chandan, big ticket reforms, a GST overhaul, so to say. What would be the impact? What would be the likely impact on the market? Because the Nifty cleared that 100-day moving average level yesterday itself. Today, 25,000, a dash at that looks imminent. But a close above that, would you be watching out for that? And how confident are you that we'll close above 25,000?
Good morning, Nandita. Thanks for having me. So, market witnessed decent recovery on the last trading session, and the GST reform and
Chandan,
GST
are you on
regime
mute?
could give some bullish stance. However, we need to keep in mind that the follow-up buying is very important in this market scenario. But as of now, we believe if market manages to hold 24,700, then it has potential to bounce towards 25,000 marks. So, after the positive opening, buy on decline kind of stance can be applied in the market. One need to keep in mind that selective sector and stocks will do well where we are getting major relief in terms of GST, whether we talk about selective consumption name or the auto ancillaries. So one need to focus. And for index till it holds about 24,700, continue to be with buy on decline stance in the market for target towards touching psychological 25,000 marks.
But let's take a look at the markets. They have opened up and 160-point gap up. 24,871 is where we are at. So yes, we will see whether we can make a dash at that 25,000 level. Nevertheless, it's a good start. A 150-point up move yesterday as well. We ended with triple-digit gains, recovering 200 points from the day's low. Today as well, building on those gains, round about the 24,900 mark. But let's see whether the bulls have it in them to clock in that 25,000 mark as well. But Sensex up a cool 600 points. Mid-cap index as well, moving in tandem with the benchmarks, almost a percent higher on the Nifty mid-cap index as well. And banks yesterday made a very good comeback. Finally, they did end the day with good gains, and banking names did well yesterday. Today as well, the bank Nifty is extending those gains. In fact, it is firmly above that 54,200 mark as well. So yes, good going. In terms of advanced decline ratio, stupendous. 9:1, that's the Nifty NSE advanced decline ratio. But we'll, of course, wait for that to settle down. Early days to really call it a trend. 1,900, almost 1,900 shares advancing to 214 declining. So the breadth is looking extremely good. But let's see in terms of sectors, which are the sectors that's taking the lead. I would really want to watch out for the FMCG pocket, the Nifty Consumer Durables Index, the Auto Index. These are some of the pockets that have already seen a fair bit of run, but of course, we do expect a bit of a sentimental impact today as well. 2.5% uptick on the Auto pack. FMCG index up 2%.
I need a kuch
Realty index is also up 1%. Remember, real estate will be a beneficiary of the cut in GST for cement as a whole. So, which is why the realty pack is also up a percent or so. Across the board, buying all the sectors are trading in the green. Even IT, yesterday, of course, IT was out of favor. Even day before, it was out of favor. But today, slim gains coming in for IT, but even IT is participating. So yes, all the sectors are trading, firmly in the green. But let's see some of the stocks that are really, making big moves as a result of the GST reforms. M&M, the management was there on CNBC TV 18 earlier, and they also spoke about how 60% of their portfolio of CVs and other vehicles will fall under the 18% bracket. So yes, M&M had taken a bit of a breather, last earlier this week, but M&M in fine fettled 6% higher. Bajaj Finance, that's number one consumer finance company, India's number one consumer finance company. That will also be a beneficiary as people take more loans and buy more buy more products. So yes, Bajaj Finance, that stock is up 4%. For on anticipation of higher demand for credit, and Eicher Motors, that's also up 3%. Because a large part of its portfolio is under 350cc. So yes, Eicher Motors also a big beneficiary, up 3%. Bajaj Finserv is also gaining 2.5%. Ultratech Cement up 2%. Grasim up 2%. All these Nestle, Hindustan Unilevers that were witnessing some bit of profit taking in the last two sessions have edged back into the green. Tata Motors also gaining traction, 2%. ITC, Trent, Hero Motocorp, all the names in the green. I would like to see what Vishal Mega Mart and V2 Retail are also doing, because these are also big beneficiaries, of the GST cut. But Eternal is out of favor today. Yesterday, Swiggy has once again increased its platform fee. Day before yesterday, Eternal also did the same. But today, Eternal is under pressure. Reliance is also under some bit of pressure, 0.5% down on that. Some of the metal names that saw good buying yesterday, Tata Steel, Hindalco, GSW Steel, they're taking kind of a breather today. Some IT names are also on the laggards list, and so are some of the pharma names like Sun Pharma. Dr. Reddy is also in the red. Just want to see what some of these life insurers are doing, because of course the removal of GST from life and health insurance premiums, they are trading flat, but they've also mentioned that they will be passing on the benefits to consumers. That was mentioned in the press conference yesterday. But they would of course await clarity as to how they will be compensated, or what kind of relief will be provided to them for the input tax credit that they will have to forego. So yes, that's all about the market open. But Chandan, what would be your GST play then? Look at the likes of M&M, Bajaj Finance, all of them are flying high. What would you look at as GST plays, and which sectors would you really focus on? All right, there seems to be some audio issue. We will try and fix that. But let's take a look at some of the mid cap movers. Then, on that note, we want to see which are the smaller stocks that are moving today across the broader universe. On the Nifty 500 in particular, uh, just waiting by for things to really settle. But yes, the traction in the market continues, and it's a 140-point up move on the index now. Lost slightly from opening highs, but 24,851 is where we are at. Want to see what some of the stocks are really doing. The likes of Voltas, Whirlpool, etc. Voltas is down somewhere around a percent or thereabouts. Whirlpool, that stock is also trading. I think it's largely flat, so to say. But yes, but there were some other stocks that were also in focus aside of the GST related news flow. Aptus Housing, it was supposed to see a big block deal today. pre-now trade, so to say. Westbridge Capital was looking to sell 16.5% equity stake in the counter via block deal. The deal size is somewhere around 2,600 crore rupees, and the floor price was set at 316 rupees per share, which was at a 5% discount to the current market price. The stock has been, witnessing some bit of pressure. It's down 5% in the last 1 month, but it's up somewhere around, 1.5% in the last 5 days or so. Just want to see what the share price of Actis Value is doing. It has of course seen a downtick from opening moves. But still it's managing to hold on to gains up somewhere around 0.6% or so. Want to see if you'll be getting rates for the Nifty 500 movers or not just yet. I think it's just about starting to trickle in. No. So we will wait for that data to flow through. But in terms of other movers, I want to just point out that the likes of ITC are also doing fairly okay in trade. In fact, among the top gainers, so to say, up 2.5% on IT. Aside of that, look at the likes of Adani Ports, ICICI Bank, um, Asian Paints, Apollo Hospital, HDFC Bank. All of these banking names are also firing up. Saw a good move yesterday, and they are extending their gains. But let's see if we can touch base with Chandan again. Chandan, is my voice reaching you? Okay, so we have lost Chandan. Let's see if we can get the other guest in till we, fix things with Chandan. But in terms of brokerages, then I want to understand and tell our viewers as to how the street is really looking at the GST reforms and what kind of impact they are envisaging on demand going forward. CLSA has come out with a note on the GST rate rejig. They've said that they are estimating somewhere around 6 to 11% kind of reduction in consumer prices going forward, and they see the changes as a big positive for FMCG demand, for food and home care, and even for personal care. These are some of the products CLSA believes would benefit the most. In terms of top beneficiaries, Britannia and Colgate, with their near complete portfolio coverage, these are some of the stocks that CLSA has singled out when it comes to some of these FMCG and personal care names. QSR and alcoholic beverages also stand to gain from input tax reductions, according to CLSA, as they don't really receive input credit. So yes, from CLSA, that's the thought. Britannia, Colgate, well placed, in terms of demand going forward. And even QSR stocks should be in focus, the likes of Jubilant Food, etc. Devyani International, all these stocks also stand to benefit, even Mrs. Vectors for that matter. In terms of what Morgan Stanley has to say, it has said that GST cuts will benefit consumer companies broadly. Staples are expected to see growth, and there could be a shift towards organized players as well, as prices come down. Food companies, according to Morgan Stanley, like Britannia, Nestle, Tata Consumer. These are some of the names that Morgan Stanley has pointed out that stand to benefit rather than home and personal care. So yes, Morgan Stanley believes that food companies will benefit more compared to home and personal care. Retailers and discretionary players like DMart, Vishal, and Page. These are some of the stocks that Morgan Stanley has pointed out that could offer sustainable growth going forward. Now, since 15th August, Morgan Stanley has clearly pointed out that staples have outperformed discretionary stocks, not so much. So here on, there could be a further leg up, in terms of discretionary names. That's what Morgan Stanley has pointed out. In terms of insurance, CLSA has said that, of course, as a result of removal of GST on insurance premiums, policies will get more affordable, but insurers will now have to bear the GST on expenses without any input tax credit, right? And they are saying they are saying that they are expecting price hikes of somewhere around 1 to 4% on policies. SBI Life, according to CLSA, has the lowest, operational expense ratio, and that's why they will need minimal hike to offset higher costs. So that's the view from CLSA. Morgan Stanley, on the other hand, is saying that third-party insurance for goods vehicles, it has also been cut to 5% from 12%, and that's positive for customers. But elasticity, impact is yet to be seen as to how really that pans out. But of course, there is a fair bit of uncertainty as to how insurers will be compensated or given any kind of relief in terms of input tax credit. But if relief is not provided, premiums, in fact, may rise according to Morgan Stanley, and that will reduce the net benefit that would have otherwise accrued to customers. So overall, that's the view from the brokerages. I think there's a Kotak institutional report as well, which stated that calculations suggest that all these GST changes would lead to somewhere around 2 trillion rupees in household savings. Whether all of it will go towards demand, whether some of it will go towards capital market. I want to really touch base with some experts and pose this question to them. And I think Kotak also stated that. The GDP impact would be somewhere around 7 tenths or 8 tenths of a percent, as a result of these changes, uptick in the GDP growth going forward. Just want to understand from experts whether, all these reforms will offset the tariff impact that would be felt on GDP. So yes, we will be getting to those experts. There's some audio issues that we are sorting out, but let's also listen in to what the finance minister had to say, in the late night presser that they did post the deliberations on these proposals. It was supposed to be a 2-day meeting, but there was consensus, and that's why it was concluded just in one day with all the big bang changes to the current GST regime. But let's listen in to what the finance minister had to say.
This reform is not just on rationalizing rates, it's also on structural reforms, it's also on ease of living.
All right, then that. क्यों तो करो यार. All right, then that was the finance minister. Landmark changes to the GST regime. But we just want
This
to point
reform
out
is not just on
that some of the
rationalizing
healthcare
rates,
makers,
it's
I think
also
Lal
on
Path
structural.
Labs, etc., will also be in focus because of the cut in GST rates for some medical equipments, etc. Just want to see what shares of Lal Path Labs are doing. Although they are trading in the pharma pack itself, some of the stocks are not participating in the upmove really. We saw the likes of Dr. Reddy's, etc., under pressure, even Sun Pharma for that matter. So yes, pharma once again out of favor. Yesterday we saw a good up move in the pharma names, but today, of course, as I can see, M&M, that's the top stock, 7% up. Just want to see what Maruti is also doing because small cars have seen reduction in GST rates to 18%. Although Maruti reaction is fairly muted. uh, that was something that, of course, is said to benefit Maruti because the segment is small car segment is struggling. So yes, this will provide a booster shot to that portfolio for Maruti. But right now, the impact, reaction from Maruti is fairly muted in comparison with an M&M, which of course have taken off in trade. Aside of that, of course, we will, of course, be getting you more, some expert views on how to really go about, rejigging your portfolios post these big ticket, reforms. But let's also listen in to some more, inputs from the council itself. And of course, the state finance ministers also had a few things to say. Let's listen into some of those soundbites.
From 28 to 18%. on small cars and motorcycles which are equal to or below 350 cc. Reduction of GST from 28 to 18 on buses, trucks and ambulances. Uniform rate of 18% on all auto parts, irrespective of the HS code. Three-wheelers from 28 to 18 again.
Finance Minister after that late night presser on GST reforms. Just want to see what are some of the other movers in trade before we get on board our expert on the show. Just want to point out, of course, cement names are doing well as well, post the GST cut. Uh, you know, Stocks like HDFC Life, in fact, have also picked up traction. HDFC Life, that's trading higher by 2% or thereabouts. And let's see if we have our first guest joining in or not. Pankaj Pandey, head retail research at ICICI Direct. Pankaj, if you can hear me, good morning and welcome to the
Good
show.
morning.
Your first thoughts on the big bang GST reforms. Of course, it would lead to, higher demand for mass consumption products, right? So, how would you really play, or how should one really play this theme vis-a-vis, between staples and discretionary? Where do you think, you'll see a higher uptick in terms of demand? Would it be staples or discretionary? And how should one really play this theme now in terms of consumption?
Yeah, yeah. Hi, good morning. Thanks for having me. I think between the two, our sense is that discretionary is something which should sort of stand out. I think the rate rationalization for a big category like auto is a structural positive. I think there was some concerns that whether the tax incidence, which was to the tune of about 50 odd percent for SUVs, will it be sort of there or not? But I think that has sort of again come down to about 40 odd percent. For tractors, it's absolute positive. Besides, you've done for tires. And I'll not be surprised if some bit of a demand also shifts from the unorganized or basically the secondary market to primary market. So all in all, I think for auto, it is one of the biggest positives which we see. On top of it, I think you have categories like, say, for example, air conditioners, which is again a big category. The challenge was that while we are selling about 1.2 crore kind of air conditioner, about 20 lakh kind of inventory was with the producers, and I think that will sort of provide some relief. So discretionary is definitely going to be beneficiary. On the staple side, yes, things are positive, but and it might help people to sort of upgrade more. But between the two, if you ask me, I will any day prefer discretionary, because as your income level grows, discretionary is something which will find more favor.
Hmm. Okay, discretionary will find more favor, but for staples, we've seen a very good rally play out. But for discretionary, do you see more upside from here? Because in comparison to staples, discretionary hasn't really rallied that much.
So I think we need to sort of we shouldn't be judging it on today's reaction basis, because our sense is that while yes, staples have will be beneficiary, but see, a lot of categories are sort of penetrated fairly. So from that perspective, I think one needs to see the kind of penetration. So I really would not expect for a category like, say, toothpaste, penetration is already fairly high. So from that perspective, you don't expect too much of a volume growth to be driven. It will be largely price-driven growth, and so from that perspective, some bit of a margin uptick can happen. It can also happen is that possibly some unorganized or organized movement can also happen, which is what you see for a lot of FMCG products, especially if you sort of go to the hinterland, you see a lot of copy paste or copycat versions of a lot of leading brands. So some bit of a shift can happen there, but like I said, I think discretionary is where penetration plus the overall moving up the is a fairly established trend. So I would want to believe that it is more beneficial for the discretionary.
Sure. In terms of earnings, what would you say? Would you say that it will not just be a one-time kicker in FY27, and could something change structurally when it comes to earnings going forward for consumption?
Oh, yes. I think not only for consumption, our sense is that when you look at the capacity utilization of the industry, it has the potential to sort of improve the capacity utilization, which again would mean that it could sort of trigger a capex cycle as well. On the overall sense is that when you look at some of these direct beneficiaries, we see a lot of indirect benefit as well. So, for example, even the financials will sort of tend to benefit because a lot of categories like, say, for example, auto, again, will benefit. So, be it a lot of NBFCs or banks which are catering to that segment, they could benefit. Even our sense is that a lot of these consumer durable categories also will sort of start finding favor. So, something like Bajaj Finance or even other players could sort of benefit. So from that perspective, it will have repercussions across segments. So we should not only look at the primary beneficiary. I think you will also see a lot of secondary associated benefit coming up. And I think in some days' time, we'll sort of figure out in terms of the quantum of benefit for each segment. But in general, it's not only the primary benefits which will accrue, but even the secondary benefits are expected to be significant.
Hmm. I want to ask you about the auto universe. We can see how M&M is really reacting, but Maruti not so much. How would you play the four-wheeler space? We had the management of M&M on CNBC TV18 as well. They were saying that 60% of their CV and other product portfolio will now fall under the 18% tax bracket. And of course, Maruti also stands to benefit because of their small car segment, right? But, in terms of a choice, if an investor has to make, which one should they tilt towards, Maruti or M&M or a mix of both?
So between the two, my primary choice would be M&M because there was some concern that the luxury portfolio will sort of get taxed higher. Plus, there was also concern on the EV side as well that for a certain price bracket, the overall tax incidence will go up. And I think so for M&M, I think it's a complete positive surprise whether you look at tractors plus associated tires for the same, or whether you look at three-wheelers, or even if you look at on the CV side. I think all their portfolios factored in by the
Okay, I
market.
think. Go on, Pankaj. There was some issue, but now it's sorted. Go on.
So I think M&M is going to benefit across its portfolio. So I think that is a bigger beneficiary. I think Maruti has its own set of challenges. So while yes, they've been launching products, but on the SUV side, I think they are still sort of lagging compared to competition in terms of product pipeline. So between the two, I will prefer more of M&M compared to Maruti. But I would want to believe that even Maruti also is going to be a big beneficiary because next year you will have 8th pay commission also probably kicking in. So sum total, even Maruti looks quite attractive. So both are buys at current levels.
And within the two-wheeler pack, we know that Hero stands to benefit, GST rate cut to 18% for under 350cc. Eicher as well. Bajaj Auto also has kind of underperformed if you look at the two-wheeler pack. How would you spread your investments when it comes to two-wheelers?
I think two-wheelers is largely a fairly penetrated category. I think for Eicher it is slight negative because 350cc and above bikes, the tax incidence will go up from say 31% to say somewhere about I think 40 odd percent. So bit negative for them, but although volume wise it's not a big category for them, but so from that perspective it's bit slightly subdued for Eicher. I will place my bets on Bajaj Auto. I think Bajaj Auto relatively should benefit more. Plus, they have also been doing very well on the export front. So that plus, I think TVS is what I think should do well.
Okay, and how about insurance? Because although it would lead to deeper penetration, and of course, GST has been done away with, but not much for insurance companies in terms of what they incur, right? They wouldn't be getting input tax credit. So, how much of a concern would that be in the near term until they get some clarity as to how what kind of relief they will get? Do you expect premiums to go up, or how do you think this will be playing out going forward?
So I think if you look at from a pecking order perspective, HDFC Life should be the biggest beneficiary because they have the highest portfolio of term plan. While investment products, again, need to see a segregation between the investment leg and also on the insurance coverage side. So that leg will benefit. But whosoever has got higher share of term plan, I think those are expected to be a bigger beneficiary of HDFC Life and SBI Life should sort of benefit. LIC largely has not been very aggressive on the term insurance side, so I don't expect them to be a big beneficiary, but they are expected to sort of pass it on. So while yes, it is possible that the cost might go up for them, but I think volume growth or higher penetration is where probably things will look a lot more exciting for insurance companies.
Hmm. Sure. I also want to get your thoughts on how these cuts will benefit QSR and even some of these platform companies, the new age tech ones like Swiggy and Zomato. Would you tilt more towards the new age ones, or would you look at QSR because input costs for them also will go down, and of course they will also be beneficiaries of an uptick in consumer demand?
So I think on the QSR with the reduction in rates offered across key materials, for QSR, so they might sort of pass on the benefit to the customers, and it might improve the like-to-like growth for them because which has been sort of very lackluster for a lot of these players. So a lot of these dairy products like say cheese and butter with the tax incidence sort of coming down. I think somewhere down the line, I think it is definitely positive for a lot of these players. So it has the tendency to sort of revive the subdued growth which has been there. So again, positive for most of them.
Hmm. So is this the time to have a bigger proportion of stocks related to consumption rather than manufacturing? What is your overall thought in the consumption versus manufacturing sectors now?
So if you ask me 5 to 7 years, I'll definitely prefer the manufacturing theme, largely because see, eventually we need to sort of create a lot of jobs, and that is where the manufacturing leg needs to sort of perform. And but yes, from the next 1 or 2 year perspective, probably the consumption theme might sort of outperform compared to the manufacturing theme. But I think it all depends on how one sort of places. So if you're looking for a medium term, I think it is consumption theme obviously is going to be the primary theme.
Okay, in the medium term, consumption will be the primary theme. But Pankaj, last couple of questions then. For textile and garment makers as well, we've seen a rate reduction in GST, but of course there is the overhang of higher US tariffs. Do you think this will be enough to offset some of that concern? How would you play into these export-oriented themes? After the US tariff and this GST benefit that has been rolled out to them.
So domestic demand side, yes, it is beneficial. Value has been moved to 2,500. So definitely it is positive for the entire textile place. But from the export front, I think the challenges are still there. But yes, when you sort of look at the global setup, while US does import 15% of the overall textile, or they are one of the biggest importers, but you have other geographies like say Germany, a lot of countries in the EU side. So any kind of a deal with EU will be a sort of a structural positive. And even just to highlight, so for example, a country like Japan, while they import nearly 4% of the overall global textile, but India's share there is very minuscule. So from that perspective, some bit of a diversification can happen. I'll not be surprised the way things got rewired in crude oil. Possibly over a period of time, it might happen even in textiles as well. Given the fact that we produce nearly 23, 24 odd percent of the overall global cotton production base. So some categories can't be replaced with man-made fiber. So I think there is some inherent strength which we have. But yes, in the transition period, probably things can be challenging for a lot of these export-oriented names.
Hmm. All right, so that's the view. Just one last question, Pankaj, before I let you go. So, what would you prefer? Would you look at some of these retailers like Vishal, Megamart, V2 Retail, etc., in anticipation of higher demand, especially ahead of this festive season? Tactically, would you look at these names?
I think I might prefer DMart more because they have a fair share of both daily consumption product categories plus even the textile leg or apparel leg as well. So I think they might sort of benefit more. So I will go with DMart than some of these names.
All right, that's the view, Pankaj. We'd like to thank you for joining in this morning and sharing your thoughts with us. I look forward to interacting again in future. Have a good day and hope to see you again soon.
Thank you so much.
Thanks a lot. Well, that was a view from Pankaj of ICICI Direct. But let's take a look at some of the other names that are hogging the limelight today. Just want to see what some of the mid cap names are doing today. Can see stocks like Escorts, Policy Bazaar, Colgate. These are some of the stocks in focus. I can see Escorts up 9% as a result of the GST cut. Colgate is up 5%. Policy Bazaar is also up 5%. Aditya Birla Fashion is up 4%. Jubilant Food is up 3.5%. Apollo Tire, all these, auto ancillary names are also up. Tires and of course even those NBFCs like M&M Financial are up and about. The likes of Nika on the back of hopes of better demand and as a result of higher spending power. Those stocks are also up somewhere around 4%. Polycab is also up somewhere around 1.5%. So all in all, good gains coming in across the board. I just want to see what the headline indices are doing. Yes, we are picking up traction. 24,900. That's on the charts right now. Still 100 points to go for that crucial 25,000 mark. But let's see if the bulls really have it in them to really hit the accelerator on gains, and of course whether we can really reclaim that 25,000 level today itself or not. Mid caps also moving in tandem, although they are underperforming today, mind you. Vis-a-vis a 1% gain on the headline indices, we can see 0.5% gain on the mid cap index, but the breadth is also fairly strong, as has been the case in the last few days. But let's get on board. Our next expert for today joining me is Sunil Subramaniam, Big Market Voice. Sunil, it has finally happened early, a day early, so to say. Last night, of course, GST reforms being announced, non-expected lines. But what are your thoughts? Because I was reading reports, it says that it would leave, 2 lakh crores in the hands of, or it would lead to household savings of around 2 lakh crore rupees. Do you think everything will get channelized into consumption, or do you think some of it will also flow through to capital markets?
No, I don't think that it's all going to go only to consumption, okay? Because what happens is that it's a benefit that is across. You've seen that a lot of unexpected benefits, like the whole agri segment has got benefited, right? So what I'm saying is that while people will probably use this to boost consumption, savings, taking this into savings, you see, existing what they've already bought, the EMIs are already clicking in. Right. So this is not money which is going into their hands. It's only if they buy, they are getting it cheaper. So, right. So to that extent, yes, you can say that some amount of savings, because they were set aside, let's say, 10,000 rupees for a EMI, and now they're paying 9,000. So it's a potential saving. But I think people don't think in those terms. I think what's for me important in this is 2-3 things. One, you already mentioned, the meeting finished a day earlier. So the consensus of the country, of the opposition and the center government to come together to this. I think that's the first thing, because once Mr. Modi announced it, right, a lot of this news was in the price. But would the states object? Would there be a huge issue of revenue losses? What would happen? Will that be a dragged on meeting and the states have to fight with them? No. So a very smooth acceptance of this. That's a huge positive. That's number one. Number two is that I think that Mr. Trump needs to be thanked for this, because I think it's because of the tariffs in a way that the country has come together, right? This is the musibat samne aati hai, to everybody takes up. That's a very important point, right? The third is that if you look at it, I think finally the government has now used all the astras in its armor, right? It did a tax cut of 1 lakh crore. I say now there's a tax giveaway of 2 lakh crores potentially, right? There's the RBI which has done a rate cut and liquidity infusion, right? And so now it's clearly the ball is in the hands of the private and the public sector companies, right? So now there's no excuse, right? Why I'm saying this is from a capital market perspective, from the stock perspective, I don't want some companies to be thinking near term small and saying, can I use this to boost my margins? The ultimate price to the consumer. So you got to have that foresight as a company to say, in fact, take a cut on margins, make the whole package more attractive to the consumer and let the boost happen. Firms will make up, but I don't want some companies to slip into a short-term tendency. This is where I can protect my margin. There's a 10% cut in GST. मैं 7 pass on करूंगा, 3 I'll keep to myself. I think that's something you got to protect. Make sure that it's passed on, because second aspect is that if you look at it here, this is actually a multimodal, multi-sectoral boost to the economy, right? Because you've said agri, you've seen medicines, you've seen insurance premium, you've seen automobiles. So when you have this kind of a thing, I'm hoping that the volumes, right, come in, and the real sector to bet on today will be the capital expansion sector. See, because this is going to finally attack that K-shaped consumption bit. See, the rich things have become now at 40%. So the fact that only the rich products, the higher end products are getting sold, now with the bottom of the pyramid getting a huge amount of giveaway, the mass consumption should pick up. And with that, capacity utilization will cross that magic 80% mark. And I think when that happens, right, the greenfield of the cap is from the private sector. Right now it started, but it's more in power and a bit in infra. But you need broader manufacturing companies to be expanding their capacities. That kind of a multiplier which will come in is phenomenal. So I think that this is the time. Post Mr. Modi's announcement, I think 60-70% of the consumption boost expected came into the price. You saw the rally. FMCG did not pick up so much. From today, it should also pick up. So maybe another 20-30% rally is left in the consumption related spaces, right? Auto, realty and all that. But the real pick today, if you have a slightly longer term perspective, would be the capital goods sector, because I think this is going to be the thing which kickstarts private capital in the country. And that's the real takeaway, that I think you should now reconstruct your portfolios around that. In fact, consumption would be more of a safer bet because it's there in the price. So you will get a little bit of gains, but from a real wealth creation perspective, you've got to look forward. That's one. Second is in the capital market. So yes, capital market stocks and everything will get the benefit of potential coming. But look at it this way. The market rally is still dependent on our dear long lost brothers coming back, the FIIs. The return of the prodigal son. See, even post the August 15th announcement, right? And the S&P upgrade and the PMI numbers coming positive and the monsoon numbers looking good. Every positive, the FIIs are still net sellers.
Discounted.
So where is that tilting point? Is this today?
A Fed rate cut, will that move the needle there? Will that reverse course? A Fed rate cut, that's also impending in September itself?
A Fed rate cut will help, but I'll tell you where the issue is. The issue is not that emerging markets have not got money from the FIIs. If you see the rally in the Chinese market, the South Korean market, emerging markets have actually outperformed all other markets, but India has underperformed the emerging market. So it's not that there's money lacking for emerging market money. It's that India has been viewed as expensive. India has been viewed as this growth has already been discounted. India has been viewed of there's still a tariff threat. The fact that India has taken a tough political stance against a tariff means that 50% isn't going away. So those things are there. Now, because of the Fed rate cut, the emerging market pool will go up a little more. Yes, India will get a trickle of that. In the passive funds, we are over 15.9% of the MSCI emerging market index. So to the extent that emerging market passive flow increases, we'll get 16.9 rupees out of every 100 rupees that goes there, technically. But That will be a little bit of a boost. But what we need is a sentiment shift in FIIs. See, there is going to be a sentiment consumers, hopefully, there's going to be a consumer sentiment shift in domestic retail equity investors to the extent that they've been a bit worried. Maybe they can come in stronger. Mutual funds, of course, have been continuously buying, so not an issue there. But we need a sentiment shift in the FIIs. Now, that's where we have to wait. I'm hoping that this, the way the country has responded to the tariff situation and that everything is good, finally tilts that and FII turns become positive. And also, I think that use of the fiscal plus monetary policy in a very strategic, step-by-step manner, recognizing the problem the country faced ever since the post-COVID, is that we have been in a K-shaped income disparity and a K-shaped consumption. By now taking that money and putting it in the hands of the middle class and the lower middle class through GST, through income tax cuts, right? That boost to the bottom of the pyramid consumption that's absolutely critical, and I'm glad that they have thought the right way. The second aspect, and though it's not so much capital market related, I'll tell you, is the health consciousness that has come through in this. You see, they have the sugary based drinks more. You see, they have brought down the tax rates on protein based inputs like paneer, right, which is healthy. So I think that there is also a layer of that balanced approach where they have seen that the health of the country is also important. So I know it's not so much a capital market thing, but overall, I'm trying to still sit in the mind of an FII and look at what's happening in India. And can I stop my net selling and turn net buyer on the fastest growing country in the world?
That's true. Sunil, of course, you mentioned an array of points. We'll come to it one by one. But, of course, we discussed at length that, money is not flowing in. Although it is flowing into emerging markets, we have underperformed quite a lot, with respect to emerging markets, even US markets for that matter. How, is valuation a pain point then? And if at all there's some, understanding with the US on the tariff front, I was just reading one of the articles that said that one of the US experts has told Trump to apologize to India and scrap 50% tariff. Of course, I don't know whether that will happen or not. But if there is some kind of a deal by November, as was being pointed out, or as was being said by Mr. Piyush Goyal, what kind of a multiplier impact do you see? Because there will be, reading economist reports, you can see that there could be some 50-60 basis point impact as a result of tariffs. But as a result of the GST and demand uptick, etc., I was reading some reports this morning. It said there could be an impact of 70 to 80% on the positive side on GDP. But if the tariff things come together, 8% kind of growth or upwards of 8% growth for India, would that be a very, very credible expectation?
So let me, and you asked the first half of this, you asked me a question. I'll take that and answer the second half, which is that, is it only the valuation that's preventing the FIS from coming in, right? So and I'll tell you that we need to deconstruct that a bit. So if you see the news, the contradictory news, right? One is that India exports to US is at 2% of our GDP. Right? And at $47 billion of impact, right? Certain sectors will face the heat, but overall as an economy, max 50 basis points, maybe one or two bad people have been saying 1% in the GDP, but that's not the thing. What is the thing which is affecting the FIIs is not that, it is that the second half which you said, right? What is that? Is that, see, for India to get to that 8% to 10% GDP growth, we need the US as a market. Now, this is not a very popular thing to say this because sentiment is anti-US in India right now. We are very angry with Mr. Trump for slapping the tariffs, for talking us as a dead economy. There's a lot of anger against. But bear in mind that if, given the fact that our per capita income is less than $3,000 and the fact that we are adding 15 crore people to the workforce over the next 2 decades, for doing employment to them, for boosting our current fate that we didn't succeed in the past with US exports has protected us from this tariff thing. Okay, so our current is protected. There's only a 50-60 basis points, and even if you shave off 1%, we're still the fastest growing country in the world. That's not it. An FII who's coming in, a sovereign wealth fund, a pension fund, is looking at 10-15 years. And what he had factored in is that this economy is going from 6.5 to 7 to 7.5 to 8 to 10. And which was based on the China Plus strategy implementing itself, that the US shifting its $400 billion trade deficit to China to a to India and leveling it. And Mr. Modi's first visit to Trump, where they talked about almost more than doubling the $190 billion trade volume to 500 billion. See, that story has got punctured, right? Because if you're now fighting on the current itself, where is the potential for India to grow to that? Correct? So that's what is preventing the FIs from really coming in. See, current valuations is a tactical call, right? If it just comes September, right? From October onwards, you will get a time correction on the PE. You will get the discounting happening of the next FY 26-27. So automatically a 10% correction of the 22 PE of the Nifty will take it down to 20, right? Which is, at about a long-term average. So it's not that valuation so much, right, as the fact that the growth story of India over the next decade was a large extent dependent on India's replacing a portion of China through the China's plus one, because of our cost advantage and our labor supply advantage was all factored into the price. And so when you now ask me that if there is any good news on the tariff front or a making up with the US front, then FIIs, there is no stopping. It will come roaring back into India because these valuations are all a temporary fix. So for me, I would see that in a very short time of frame, Sensex could cross 1 lakh. That's the kind of upside I see. So it is a very big thing, but because it's the back of the mind, everybody is trying to play defense and say, the US tariffs are not affecting our GDP much. That's true. But what about your growth of GDP to go to the next level? You can't continue at the same 6.5% growth rate and hope to become Viksit Bharat. So you need that 8 to 10%, and that has to come from exports. We can do damage control through exports to other countries, through GST cuts, to rupee depreciation. We can defend the tariff part. But if you want to explode, unleash the animal spirits of the Indian economy, we need the world's largest economy to be a buyer. And so I'm saying that, that's the best thing that could happen is if somewhere Russia-Ukraine war gets to a closer solution, Mr. Trump then finds there's no need to punish India for Russia, right? And changes. So that's, like I said, that's the big, positive hiding, waiting. The probability of that happening, your guess is as good as mine, I guess. There will be multiple people talking. And Mr. Trump, we all know that there is the taco always there. He chickens out. He changes his mind very often. For all you know, he could change his mind. But like I said, that's just the realm of the unknown, right? We just keep every year hearing. But for FIS to decisively come back to India, that would be a very, very good step, because that's the only thing that's holding us back from exploding.
That's true, and I think that's the only good news that's missing now, because on the domestic front, we've really seen lots working in our favor. Let's talk about earnings as well for FY26. A double digit is given, and would that be sustainable? And which are the pockets that one should look at? You mentioned capital goods. Any subsets, and if somebody is really looking at rejigging portfolio, which sub pockets will you place more emphasis on right now?
So I would see. So the infra story from the government spending has already been baked into all the typical stuff that goes into a government infra, which is largely building related. So you have had cement, building materials, steel, and those kind of things done, right? And in the power also, since power capex has been seen, you've seen those turbines and those kind of things go. But when you look at the manufacturing capacity expanding, right, then there's the engineering goods, which is the biggest subset there, right? Which is where you need to go and for setting up a fresh capacity, the machines that need to be bought. So I would say industrial stroke engineering goods, right, would be the bet which would really benefit from these order books. That's one. The second pocket for me is that all of this capex to be financed, it's the public sector banks which are going to be there. Because see, to lend to an L&T and to a Reliance or to somebody else, now everybody is there in the play. But to lend to an MSME which is going to execute that order, right? That is only PSU banks ki bas ki baat hai. Because They know that segment. They are not so worried about the balance sheet strength and this. There's still a lot of name lending. There's still a lot of track record, cash flow based lending, right? They take those calls. And the spin-off is that a lot of this imported cap goods are imported. So there are LCs and guarantees needed. So the public sector banks are the ones which are in the forefront. So to me, if the private sector capex really picks up, it's the public sector banks lending. And that lending is at 12, 13, 14% interest rates. So not only will their loan book grow, but their net interest margins also will be very, very strong. So I would say that for me, like I said, industrial and engineering and public sector banks are the two ones which are not immediately in the radar, but would definitely come through if finally this whole package of GST plus tax cuts works through in the consumption space. So I think that's the bet I would like to take a look at, say, where's value? And the value I'm looking at is a price earnings growth multiple. So from that perspective, you look at it, that's the future growth. So you should buy something before the market becomes fully aware of it. The market right now is in that consumption hawa. So everybody is out there buying a consumption. So let them be there. But you have to be slightly off the downtrodden track. You've got to go the road less traveled and look into the future. So to me, those are the two spots which I feel will really benefit from this whole structure. The other thing is, of course, was that post Mr. Modi's announcement, auto realty consumption was broadly already expected to. The surprise package today was in terms of the agri space. How much they have done in the agri space was unexpected. I think that's again something which we'll see a good rally in the near term. The second is, of course, is in terms of the healthcare related areas. Not only the insurance premium part, but medicine costs have come down. So I know, and they are, like I said, I like the fact that this time they have been very balanced. And put on their thinking hats for the good of the nation. So because all this, like say, paneer, protein-based stuff, right? They've taken away the taxes. Sugar-based confectionaries and sugar-based sodas and drinks, they have hiked it. So there is also that element of, using this as an opportunity to channelize people in the right direction, right? So that focus on the health, I liked it very much as a nation. Because America, what is suffering from this obesity crisis and everything because of this sugar-based thing and all of that. So I think that's been a very nice thing that's been involved. And I see overall the healthcare segment hence benefiting hugely from this kind of a move.
Sure. Sunil, one more thing I want you to put into perspective is the thin goods part of it. For now, of course, tobacco and the cigarettes and all will be taxed at 20% plus cess, but then they will move to 40% as well, right? Without cess. So put into perspective what this really means for players like ITC and Godfrey Phillips, etc.
So I would actually be a contra and a buyer here for the reason that these are price inelastic. Smoker going to pay another 10-15% more in terms of for his cigarettes is not going to make him cut down his cigarettes consumption proportionately. So there's this income elasticity here, right? And a smoker, yes, overall, and I don't think that this kind of a tax is going to make a potential smoker not be a smoker, right? So these are all habitual things. These are all, to be the in things in the with my friends that I need to do this. So I think that these are very resistant to price increases. So to the extent that market takes a negative call on these sectors, I would actually be a buyer because these are ultimately inelastic goods, which will, do that. And these companies also don't need to then cut their margins to boost that consumption, right? So I think the market will react to this. And I feel that's a buying opportunity because otherwise, these are good, solid companies. So I don't think that they have seen historically every budget used to hit the cigarettes with a additional excise duty, but still those industries continue growing. So to me, actually, the sector is a contra sector. Also, take in the cars. If you take the higher end cars, also now treated as sin, right? Okay, right. Now look at it by a perspective, right? Already a huge chunk of it was anyway taxes. Now at the margin that goes up, the guy who's buying a big, BMW EV or a Benz EV and all, he's not really so worried about these kind of a things. If at all he takes a loan, it's only for tax purposes, right? So I don't think that even the upper end market, right, where there will be a rush to buy things before September 22nd, obviously, right? Because after 22nd, the cars become expensive. So naturally, all the stocks they have, the bigger cars will get sold out in the next 2 weeks flat attack. So that will be a temporary boost in their sales. But
Yeah.
overall, see that somebody is going to buy a BMW SUV and says, "Oh, now it's cheaper to buy a Tata Tiago. I will go." No way.
Hmm.
See, these are lifestyle
No, no.
purchases. They are also income elastic, inelastic. So I think that
Hmm.
actually the same goods is a good contra bet today to the extent that the market takes a negative view, because I don't think that ultimately they are going to see any drop in demand because a tax thoda
Hmm.
10% बढ़ गया. No, I don't see
Hmm.
that.
Okay, same goods, good contra bets. I like that view, Sunil. But I've got so many questions. I don't know how to pose them to you in such short time. But what about consumer finance? Bajaj Finance and the likes of Sriram Finance. Auto loans. Auto loan segment was under stress for some of these auto-focused NBFCs, right? What happens to them now? Some of them are, of course, very upbeat in today's session. Within the pack, who stands to benefit the most?
No, I would say definitely to me the larger players there, because what you need here is a quick turnaround. And you see, this has to be a combined package of the manufacturer plus the lender at the dealing counter, right? At your Vijay sales, at your this, right? So I think these guys will be very fast at offering this. And I think that at the cost of net interest margins, they will bet on volumes. So what you then need to look at is that their NIMs may go down, and part of the market's reaction to that may be because of that, but doesn't matter. It's today it's a volume growth play, right? The entire country, whether it's the FMCG or it's the lenders, everybody has to look at it saying, this is my chance to build volumes. I will take a cut on my margins but build volumes. So I am very positive that it's the NBFCs in the lending space who will be first of the tracks. They will be there at the counter. When you go to buy a refrigerator, they'll be there offering you those 0% EMI deals and converting. And the whole nation, I think, will gear towards making this a huge Navratri, Diwali, Christmas, kind of a sales blowout. So I would say all the players who are there will benefit. It's not another challenge. So to that extent, obviously a gold financing company doesn't have anything extra right now. So within the NBFC pack, right, you see it's the retail consumer lenders who are lending against durables, the auto lenders who are lending against that. It's those. And the point is that, see, people always use this to stretch. So if the EMI can come down, they'll make that next higher car, but within of course the 1500cc or what is defined as a small car, right? So I think that that's actually a very good play, according to me, is the NBFC play today.
Hmm. All right, that's the view then. But with that, Sunil, would like to thank you for agreeing to join on a short notice and putting things into perspective for us. I have a lot of questions for you, but I'll save that for another day. Otherwise, we will not have much to talk about next time. But thank you. Thanks a lot for sharing your perspective. Always, pleasure chatting with you. And you put things so simply. It's very easy to really understand the complex issues. Thanks to you.
Thank you. Thanks.
Thanks a lot. Well, on that note, let's quickly take a look at what the markets are doing. Just about 116 points higher than we've cooled off from the opening highs. 25,000 still eludes us as of now. But let's see, we have the whole day in front of us. And of course, all these GST beneficiaries staging good rallies, the likes of M&M, Bajaj Finance, Trent, Bajaj Finserv, all these FMCG names like Nestle, ITC, HUL, all of them, staging very smart up moves. Bajaj Auto, Hero Motocorp, all of them up and about. But what's not doing well, seeing some bit of profit taking are the likes of Tata Consumer. Steel names that saw good rally yesterday have come under some bit of pressure. IT also, under pressure as we speak. But the advanced decline ratio, has also like kind of come off a bit, but still, nevertheless, it's 3:2. That's the NSE advanced decline ratio. And some of the big movers from the mid cap end of the markets are some of these QSR names and all of these tractor names, escorts, etc. They're also doing well. QSR plays like Jubilant are doing well. Nika was among the top gainers from the mid cap end of the market. So yes, the GST related reforms really playing out today. Let's hope that we can hold on to these gains. In fact, even build on these gains in the second half. That's when we see traction picking up, right? So hopefully, in the second half, if we manage to see a good up move, who knows, we can still manage to reclaim that 25,000 level. But of course, it's been a very action-packed show, and we got you views from market experts as to how can you really go about reconstructing your portfolios. Of course, we couldn't really take up individual stock queries, but we will do that tomorrow. We haven't really forgotten your queries. Don't worry. Today being an exception when we couldn't take up your queries, but tomorrow keep them handy. We will get a guest and we will get them addressed for sure. But before we leave you, here's a message for our viewers. Introducing Money Control Super Pro, your ultimate investment superpower. Get live calls, trading, and investment ideas from SEBI registered experts, pre identified chart patterns, and AI powered stock alerts on WhatsApp to help you trade and invest with confidence. Super Pro, where serious investors stay ahead. Download the Money Control app and subscribe to Super Pro today itself. With that, completely timed out on this edition of Opening Bell. Thanks a lot for staying with us. And of course, I'll see you at 3:30 p.m. with market close. Hopefully, we would be closer to that 25,000 mark. Let's hope so. But a good day for the Bulls, who did stage a comeback yesterday itself in the second half. And today we are just building on those gains. A good booster when it comes to the push in terms of GST reforms. So yes, with that thought, leave you. But stay tuned to moneycontrol.com. You'll see a variety of expert takes and opinion on what the government has done and how things really look like from here for the India story. Thanks a lot for tuning in. See you soon.